Today's market call is presented by Robinhood. Elevate your trading with Robinhood Legend, the sleek, free, customizable desktop platform built for active traders. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood financial fee schedule for more information. March is flying by. It is the 4th, 11 a.m. on the East Coast. Market call. Just Dan, just Swizz today with you. A lot going on. How are you, Dan?
You're the G Swizz. That goes back, man. That was like
G Swizz. That's
CNBC
before that whole what's her name thing. I was Swizz before she was Swizz.
Sure, you were.
All right.
Guy, it's kind of exciting. I call it 30 hours in the stock market here. When I say exciting, because there's lots of puts and takes here. Trying to figure out why we are careening lower. It doesn't take too much. We have the president speaking tonight. We have some earnings. We have the all-important jobs number. We have the tariffs that went into effect today. Quick question. How does the president, again, we've talked about this a lot. In Trump 1.0, they were very focused on the stock market. It'd be interesting to go back. Maybe, Bill, will you go into the perplexity and tweet or I guess search for how many times did President Trump in his first administration tweet out about the stock market, right? That guy, it seemed like every other day, right? So how does he get out of this little mess here? We have the stock market down, 6.5% or so from those recent all-time highs?
Well, in the first administration, not only he talked about it, but some of the people in the cabinet talked about the stock market being a report card for how they were doing or how well they weren't doing. Obviously, when the stock market went up every day, they took that as a win. This is what I think is going on, and I'm not suggesting I'm right by any stretch of the imagination, but I do think there's a thought in this current administration that if they can get yields lower, the stock market will cooperate in kind. So I think they feel that yields, and you brought this up last week, yields is the thing they're going to focus on. Scott Besson has been talking about it as well. You get the yields part of the equation right, and the stock market will figure it out. Now, I am not of that belief because I think yields are going lower because things are slowing down in a meaningful way. And obviously, that's going to have an impact on not only earnings, but then obviously the stock market. So that's, I think, the difference between the first administration and this current one. Not to suggest, by the way, they don't watch what's going on in the stock market. Clearly, they do. And I think, if I'm not mistaken, where we're trading in the S&P now, we're actually lower or right around where we were, I should say, around Election Day. So we've come sort of full turn. So I think that's probably, I think if there's a litmus test or if there's sort of a barometer, it probably comes in the form of where things were on Election Day.
Yeah, I mean, listen, we're getting to that 200-day moving average. We're getting to that breakout level from last summer. From a technical perspective, it seems like, a lot of this came pretty fast. We know the leadership led to the downside after earnings. What is that? That's the Mag 7. But the catch-up trade, guy, in like the banks today, it would act like we are literally on the precipice of a recession. And, the one thing I'll just say, people were like, oh, Scott Besson, he's a genius. He, self-made billionaire and, like in financial markets and this and whatever, Commerce Secretary, Lutnick, these guys have just become supplicants. Like if you were really trying to manage an economy in a way where you're trying to cut costs, that's the Doge, that's the austerity. You're trying to kind of reinvigorate growth from what you thought was a disappointing last few years that was mired by fiscal stimulus that, created all sorts of, inflation and the like here. They're just not doing it. And you run the risk of really tipping things to a point, right? You've been saying about the yield thing. When we first saw that about a week and a half ago, that Besson's more focused on the 10-year versus, let's say, the stock market, that just didn't make any sense to us because you had this, hawkish pause by the Fed. And at some point that disconnect and then the threat of a trade war and increased tariffs, especially ones on our biggest trading partners, which are our allies, it just didn't make any sense. So, if you think the stock market has the Trump put to it, I think you're thinking about it incorrectly because tonight at the State of the Union or whatever you want to call it, he can say whatever he wants. If they reverse these tariffs in a day or two, they look like a bunch of monkeys. And I mean that sincerely. And then you start to wonder, how long do the grown-ups in the room stick around, at least as it relates to Treasury and the like? And it's not making Fed Chair Powell's, job any easier. So I just think that, listen, I don't mean to get too bared up right here, but if these trade war continues, if these tariffs don't go away, they really do run the risk. You've been saying this, I think, the 6 to 9 months, that the economy is not nearly as strong as some of the data suggests, or the Fed has thought at different times. And that, I think was just kind of made very evident in September when the Fed cut 50 basis points in a surprise move, because they wanted to what, Guy? They wanted to support employment.
Yeah, listen, we're going to see, and obviously a lot could change in the next few hours. I mean, when you have a VIX that was at one point today, and a minute can throw up a chart, and approaching, I think today, 27.5 or 28, maybe up to 26.5, trading 25 now, you're going to see violent moves now up and down. So don't discount the ability for this market to sort of bounce from current levels at some point today. But what I've thought, and what I will continue to say, is volatility over the last couple of years has been a 1 or a 2 day event, but I think we're setting up for a prolonged bout of volatility I don't think the market's prepared for, and market participants are not prepared for a myriad of different reasons, some of which you just said. So we'll see. But I think the counter trend rallies could be violent. I'm not suggesting you're going to see one in the next 5 minutes, but stranger things have happened. But I think the trajectory is lower. And yesterday, if Amanda wants to throw up that chart, we took a look at a trend line that incorporated the August low, and we said we're probably going to get right around there. And if you longer term chart, and you'll see what I'm looking at, we're probably right at it today. As a matter of fact, that moving average is pretty much your guide, and we traded down there today. So theoretically, that should provide some serious support. And I think that's what we're seeing here. So there are a myriad of things that are going on. I mean, the way I view things, you have this sort of rolling top over the last couple of weeks. Volatility is in play. Yields are going down because things are slowing down. There's a lot of things to be concerned about here, without question. With that said, given where we traded down today, I wouldn't be surprised to see this thing bounce a little bit.
Yeah, let's go to a chart that we made just before we went on here, and this is the S&P 500. This is from election day in 2016, and then you'll see, 2017 was just a slow grind higher. Guy, do you remember, like, from a volatility standpoint? I mean, it was just a pretty fascinating situation. But then if you look at 2018, things got a lot more volatile. I just want to go back and think about 2017. There was a lot of optimism about a pro-growth agenda. The first kind of thing that the Trump administration wanted to do was lower taxes, right? And they kind of bowled that through. Your main man, Gary Cohn, was the architect of that. And then we get into 2018. This is when we start seeing, trade and tariff talk getting dialed up. We had a Fed that was raising interest rates, right? And then we had a global growth scare. And look at the volatility bouts that we had. Now, we know what happened in the Q4, right? The Fed had to pivot. It got back to those prior highs. It didn't take particularly long. I think that the amount of the sell-off, or the duration of the sell-off, was similar to that rally. And then it was just kind of off to the races, So when I think about it, and again, COVID was COVID, it didn't really matter, but it might be playing out kind of similarly. I mean, they just got this budget passed, and they're trying to get $4.5 trillion of tax cuts over the next 10 years. But, there have to be Republicans in the House who do not back that without commensurate cuts. And if you think about what Doge is trying to do, they're really not coming up with a whole heck of a lot. So, maybe we are in a period that looks more like 2018. This trade war goes on longer than expected. We are likely to see a hit to global growth. And think about this. China was in a much better position back in 16 and 17 than they are right now. They have already been, exporting deflation, if you want to call it that. So I just think that this is a really precarious time, not just for our economy. We talked yesterday about that GDP now, the Atlantic Fed thing, and the swing that is like, again, that's a sentiment thing. Who cares? But, it makes sense to pay attention to that.
I agree with you 100%, and history typically does repeat itself. Of course, history's now repeating itself potentially with valuations a lot richer than they were, 7 or 8 years or so ago. So that's something to watch as well, and that's something we've talked about, and we've said over and over again that valuations are not a timing mechanism, but it gives the market less and less room for error. And I think that's manifesting itself. By the way, you asked Bill a question. He replied. Bill said it was 156 times that he tweeted about the market, which was 57% of the total tweets. I guess you can learn that on like the Google or something, or
Well, that's
whatever
the
you call it.
perplexity. It's an
Perplexity.
answer engine. If you did that in Google, Guy, by the way, you would not get an answer like that. And the
I
beauty
see.
of that is you can go and you can look at the citations and the like here.
Ah,
Let's look at the sectors. This is not going to surprise you what's green and what's red. So it's consumer staples and it's utilities, flight to quality. You would also probably throw in there, Guy, the 10-year treasury, which is trading at 412, down from 480. I want to say what, 5 or 6 weeks ago. A heck of a move, but put the yield move in some context for a second. So back in September, and maybe Amanda can throw this up here, when the Fed started cutting interest rates, right, that 50 basis point cut, what happened to yields, Guy?
Went straight up. I mean, so we went from 360-ish, actually a little lower than that, up to 480. So what we're seeing now basically is a 50% retracement of that move in a very short period of time. Traded down to levels we probably saw back in December as well. So it is pretty interesting level. People think rates are, again, people will say rates coming down is a good thing. I do not agree with those people. As a matter of fact, Danny Moses, who's going to be on Fast Money tonight, has talked about an environment where if both rates and the market are going down, that's not going to be a particularly healthy mix. And obviously that's what we've been seeing over the last couple of weeks. And here we are now. I will still continue to say that yields are going to go higher, but you understand the reasons why I think. But if the overriding conditions are such that yields going lower is more powerful than supply, demand, and obviously the debt problems, then you have a real problem, because it speaks to what I think is going on with the economy, a really ratcheted down in terms of growth. And, Tim Seymour talks about it. You talk about it. Growth scare in this environment is a tough thing to get out of.
Yeah, no doubt. And it's something that it's going to be, the burden of proof is going to be on the bulls, if that's the case, as it relates to markets, right? Because again, the economy doesn't turn on a dime, but if you believe that things have been weakening and under the surface, the jobs market wasn't as good as it was. Some of the data on the GDP front was really buoyed by, fiscal spending and governments, hiring and the like here. It's one of those things. Again, you and I are not economists. We've mentioned this on many occasions. We had Tom Lee on the Risk Reversal podcast on Friday. We talked about, some of these issues as it relates to the, who was convinced about a recession that was going to happen in 23 and then maybe into 24. It never happened. So the idea that the R word is starting to pop up again, I think you have to take notice. But if it becomes consensus, then who knows? One of the things that is flashing red as it relates to the potential for a recession, or at least, weak economic environment. Guy, look at these banks. I mean, what's going on here today, we haven't seen a JP Morgan down 5%. Now, we did see it a couple weeks ago, and I think we thought that was very surprising. But look at what's going on in these money center banks. I mean, it's an absolute bloodbath here, as Amanda kind of points to a little bit. So what percentage of this, I don't know, I'm not trying to pin you down on percentage. How much of this do you think has to do with, people taking profits in a sector that's done really, really well, or is really pricing in the potential for slower growth?
Yeah, it's hard to handicap those things 50-50 type of things. But what I will tell you is I think it's more a function of this valuations got a little bit ahead of themselves. But not only that, some of the exuberance around the entire sector has gotten really ahead of itself as well. If you hear one more person talk about the environment for banks and deregulation and a favorable yield curve and this renewed optimism in terms of the economy and all those things. I mean, that was sort of the mantra all through the fall into early this year. And I think, people are having, or the market is having a bit of a, wait a second, let's really examine what's going on here. And did the sector get ahead of itself? And I think it did. Of course, I will say, I've been saying that for a while, and that's been incorrect. But when you have moves of this magnitude, you obviously have to take note. And, for me, it's not as much people taking profits, because I don't know if we're at that point of the trade yet, or people panicking. I think it's more a function of, hey, wait a second, let's take a look at these things and see if this makes any sense whatsoever.
Yeah, here's something that doesn't make a lot of sense to me. If the money center banks are trading this way, then why wouldn't the credit card processors trade this way? Now, I get it. Visa, MasterCard, they don't take credit risk. But you and I were looking around. We were looking at the, financials as a whole. But obviously, the money centers really stuck out to us. And, when I see a chart that did what this stock did from its January lows to just recently here, I'd say to myself, okay, this seems a little overdone to the upside. I know that's purely anecdotal. There's nothing, particularly scientific about that. But if the banks are trading the way they are, then the processors should start pricing in something for slower growth. I look at, Visa. This thing trades at about 31 and a half times expected EPS growth of 12% this year on revenue growth of about 10%. Now, is that rich relative to its history? You tell me, Guy. What would you throw? What are some of the main reasons you would say these stocks, Visa and MasterCard, always trade much richer to American Express and obviously the money center banks that have a lot of, similar sort of transaction fees built into it, but they do take credit risk?
Well, they're just straight out technology companies and transaction processing companies. And, in terms of the valuation, this is probably about the historical norm for both Visa and MasterCard. And if you want to go a longer term chart, if you've been watching Fast Money at all over the last decade or 15 years, we talked about sort of the secular shift to transaction-based companies like Visa and MasterCard, and how more and more transactions were going away from cash and going towards basically, the credit cards and the plastic. And that's exactly what's happened. Now, your point is absolutely well taken. The fact that they don't take credit risk allows them to trade at the valuation that they're trading at. But here's one of the problems that I think at some point sorts itself out. People have been combating inflation. Again, when people talk about the health of the consumer, that consumer is not healthy. I mean, I'm just, I shouldn't speak in platitudes like that, but, have they been spending? Absolutely, because they have to in order to combat inflation. They've been doing it with credit. And that's what you're seeing with not only Visa and MasterCards, but across a swath of different things. We're up to $1.2 trillion in credit card debt now. I think the average rate is probably still either side of 22.5%. Even with rates coming down, I'm here to tell you, if you think your credit card rate's going to come down, it ain't going to happen anytime soon, which again is sort of the mythology about rates and how impactful they can be to the economy, like, for instance, mortgage rates and credit card rates. So we'll see. But your point about the inevitable slowdown, I agree with that. And if you ever see, if you start to see a slight deceleration in terms of transactions processed, yeah, these stocks will take it on the chin without question.
Yeah, and so Visa looks interesting to me, a lot to do with the fact that that 300 from early January up to about 365 just yesterday. I mean, the stock is literally coming off of an all-time high. So you say to yourself as a trader, do you want in a weak market target what you think is one of the most expensive stocks? Well, sometimes that dislocation gives you, in my opinion, a bit of an opportunity, right? So valuation, we're not going to trade it off that. We're going to think about some of the things that you just mentioned relative to financial stocks that are being, baby with the bathwater. There's no discrimination between the stocks that are being sold off right now. So I say to myself, okay, how can I do this with defined risk? Obviously, I can look to sell a call spread or buy a put spread. There's a handful of other ways if I want to take a bearish view. I just want to pull this one up, and maybe Amanda will let me drive really quickly here. So, you see that move, that slow grind higher, Guy. You see where that 200-day moving average is. It's probably coming in around 302, 303. Just as I kind of tighten this thing up here, that moving average is where that gap fill is. It's also where you see that low from January. So let's look at the options here. I'm going to go to the options chain. I want to look out to April regular expiration here. We're going to get, we won't get their earnings by then, but to me, I think that's probably enough time to kind of map out what I think is a bearish move, probably back towards, I would say, first stop near, 320, but that 300 level looks really interesting. So I want to build a put spread here. I want to do it with defined risk. The stock's trading around 354. So let's look at the 350 put, and there it is. It's offered at about 865, and I want to go all the way down here to 300. Now I know what you're going to say. That's basically a $1 bid that costs about $7.50. Okay, so my risk is $7.50. You can do the math on a $350 stock. That's about 2%. Right. And so let me just go back to the chart for 1 second here. Okay, so I still have that trade built up over here. Let me just kind of move that out of here. So if I think about, look how easy this is, guy. I look at that low and I say to myself, okay, I'm going to target 320 first, but then on the downside, that 305 looks really interesting to me. Maybe Amanda can throw up what I think the payout diagram is here. So with the stock trading around 354, it's buying the April 350-300 put spread, paying about, I don't know, when we priced it up earlier, it was about $8 or $9. Right now, it's about $7.50. So if you're just doing that math here, let's call it $8. Okay. So if $8 is my max risk, it breaks even down at 342. I have gains of $42 down to $300 below that. That's my max gain. I have losses up to $8 between 342 and 350. I just like the risk reward here, especially with the way the stock has moved. Obviously, we've talked about that, some of the technical levels, maybe the valuation, but I'm risking about 2-ish% of the stock price. It breaks even down, let's call it 3.5% or so. And I can make up to 12% of the stock price if the stock is 300 on April expiration. What do you think here, man?
It looks like it's a 5-to-1 in terms of risk reward. If I'm doing back of the envelope, and you probably have it in front of you, it's probably about a 29% chance of success in this trade. You can pull up the spreadsheet and you can see,
Yeah.
and I'm probably in the ballpark here. So I don't mind that at all. And again, you can talk about legging into these things. I understand why people don't want to. They just want to put the trade on, sort of set it and forget it. What you will also say is, if you're out of the money, if this trade gets cut in half, you're going to use that as a mental stop to pull the ripcord. But, things are going to start moving pretty quickly. And I think in terms of high valuation stocks that have gotten the benefit of the doubt for a long time, if we are, in fact, in a different environment, it's going to be sort of sell first, ask questions later. So I like what you're doing here for sure, especially, given the run a lot of these have had. And, the other thing, these stocks, a lot of these names benefit from obviously passive money flows. But if that turns for some reason, you see how quickly things go to the other side of the equation. And what's fascinating, and I'll just let you go from here, all these people talking about how 0 days to expiry options are creating this downdraft. But those are the same people that failed to mention the updrafts that we saw for months and months and months based on the same exact thing. What I've said 100 different times is what works to the upside will work a lot faster to the downside. And let me tell you something, these 0 day to expiry options are completely, they are non-dogmatic in terms of whether they want the market to go up or down.
Yeah, I saw some commentary about that with NVIDIA, on Thursday afternoon where it fell out of bed. There was actually a lot of purchasing of the March 7th, this Friday expiration 115 puts, like a lot of them, right? And so that trader, or at least whoever was buying the bulk of it, got that move kind of correctly. Obviously, Friday of last week, when you saw that reversal, maybe caused some folks to kind of say, maybe that wasn't such a great trade, but it's worked out pretty well. All right. You mentioned delta, or you mentioned the probability of success. So how do we figure that out right here? So if I'm looking at the, 350 strike, that's the put that we were buying in this situation here, right? That has a 43% probability of being in the money on April expiration. So you just look at the delta. That's kind of a rough way to think about it. But if my break even is 342, I can look at the 345 strike and the 340 strike. The 340 has about a 30 delta. So it's basically saying a 30% probability. And Guy, you kind of nailed it. And about a 36% probability of the 345. So if 342 is the breakdown or the break even, you have about a 33% chance.
It's actually better than I thought. I mean, so there you go.
Yeah.
So, and I think, just in terms of the math, like, a 33% chance of being right when it's a 5-to-1 or 4.5-to-1 risk reward. I mean, I think you want to do that every day. Not to suggest it's going to work, but you sort of stack the odds a little bit to your favor, I think.
Yeah, no doubt about it. And again, if we're using a premium stop, 50%, if this stock just goes sideways, if it goes up, let's say you're paying $8 for this, if it gets towards $4, you probably want to cut it. And then again, if you probably have this going, or not probably, if you have this going in the right direction, if you see this thing trading 15, 16 bucks, maybe you take half off, play with the house's money, or maybe you roll it down and out, depending upon how you're thinking about it. So again, I think it's an interesting trade setup in the Visa, Guy.
I agree with you. And this is going to carry over into what it now is the chart of the day, because this is the KRE, which, we were talking about before the show. And, we had a whole conversation earlier about banks. And if you look at this trend line, this uptrend line has been in place since the summer. Looks like we've broken trading down to the moving average, which makes sense. You see where we think potential support could be, but things that have been seemingly impervious to just about anything that you could throw at it are now sort of falling victim. And in terms of the KRE, by the way, this has been going on since late fall, Dan.
Yeah, so the regional banks, this was meant to be one of the early beneficiaries if you thought about deregulation. Obviously, we had that situation in March of 2023, and the whole idea that you had a bunch of forced sales. We've gotten that playbook now going back to the financial crisis here, but a lot of folks thought, well, deregulation would be great for the sector. You could have a bunch of M&A here, make these banks a bit stronger. My view is that some of the deregulation that we saw in 2018, Guy, was the very stuff that led to the regional banking crisis that we had in early 2023. If you think about some of those capital ratios and the like, but this is something that really stuck out to you and me. So if you're a technician, you can kind of see what we did in those first two curves there. They look like head and shoulder tops, and they were, if you just think about them in their sort of totality. And then you look at the kind of sell-off that we had. Obviously COVID was one, and then the next one was the regional banking crisis. But if you think about it, this is a 10-year chart right here. What's forming in the 10-year chart?
A monster head and shoulders. I mean, so you've had these mini head and shoulders that have worked, and now you have sort of this monster one that, if we were to break this moving, which, by the way, I want to be clear, I think we will, and we have before, then things get really interesting. And then you start to wonder, okay, what's going on in the Russell, and why aren't small caps rallying with lower yields, and all these different things that, people took as sort of gospel. Some holes are being sort of shot into their arguments at this point.
Yeah, no doubt about it. I mean, that's one we'll continue to track. And obviously, these stocks are acting better today than the major money centers. But if this was continued, to be a sustained sell-off in the broad market, you're going to see the regional banks catch up. And I also think that, we've been like tracking a bunch of this stuff, different sectors, different risk assets that have basically retraced the entire move since the election. Before we get to one name that we've been spending a lot of time on, I want to see if Amanda will pull up this would be the Tesla, because this to me, and we were talking about this on Fast Money, I want to say a couple weeks ago when the stock was in a free fall. And I said, one of the reasons why Tesla is so interesting to me is that it really encapsulated that move since the election. All the enthusiasm about what deregulation might mean for an industry like this, what, having someone like Elon Musk, who is so effective in helping the president get elected, and his proximity there across a whole host of different sort of cabinet, areas and the like here, and regulation. And so the fact that this thing has come all the way back, it leads you to believe a couple things, right? That maybe the economy, or some of the stuff that people are kind of hoping for as it comes to like a pro-growth agenda, maybe that is just not going to be as impactful as what we felt in the first administration, because we all have the playbook right now. You know what I mean? And so I look at this thing, and you and I have been saying this, there was a good chance that this thing retraces the entire move since November 5th. Why? I don't know, not having anything to do with whether Trump gets sick of Elon, or Elon just kind of takes his ball and goes home, that sort of thing, which I actually do think is in the offing, but because the fundamentals are so bad for this company right now. And we talked about, this guy Jonas over at Morgan Stanley yesterday, who made it his top pick with a $600 price target, which is well above where the stock was trading at $485 or so in December. How do you do that with a stock that has the worst fundamentals in your entire coverage? So do you think we're going to see those two gaps filled, Guy, from late last year?
I do, and I've said it for a while, and I seemed, especially after earnings were released, when the stock, I think that they closed at 389, the worst margins they had seen in 5 years. Free cash flow beat by about $630 million, but that was on the markup of their Bitcoin position. By the way, since then, Bitcoin has come off precipitously, so you have to take that in consideration as well. And I've been saying sort of 240 makes sense, and I'm not going to run from that now. Now, was I shocked after earnings to see the stock go from 390 to about 415? Yeah, absolutely. It made zero sense to me based on that quarter. This move now makes a lot more sense. Like, I thought post earnings, the stock should have been trading 320. Obviously, it didn't. But now fundamentals, I believe, are starting to kick in. And, there's going to be a level to buy this thing, and I'll say it again and again. I think 240 is your level. I'm not a hater. I don't have any views whatsoever in terms of, Elon and what he's doing. But what I will say is the fundamentals around this company have been deteriorating, and I think the stock continues to trade lower.
Yeah. Well, it'll be interesting to see because some of the data that we saw out of Europe, I think, in Germany and France and UK was down 50% year over year as it relates to deliveries. I saw a mention somewhere this morning that in China, we're also seeing 50% declines year over year. And BYD has taken the market share lead between full EVs, but also in plug-in hybrids, which, Tesla does not have any. Elon has kind of put his flag in the sand there. They are not going to be making, plug-in hybrids. One other here, Guy, and we talked about this yesterday, the NVIDIA. So this is obviously from a sentiment standpoint, a really important stock as it relates to this generative AI trade. Last year, we saw, if Amanda can pull this up, we saw from the June highs to the August lows, a 30, intraday 35, 36% to that August 5th low sell off. Right now, we are very near, if the stock is about 112 or so, a sort of 26% sell off. And it's interesting, if you go back and you look at the 52-week lows from last April, if we were to get down there just below $80, that would be a 50% retracement. So you had to ask yourself, why would that happen now? Why would that happen in 2025? Because all the conditions might have been in play back in 2024, but they weren't, because at that point, this company was still putting up double-digit beats to earnings and sales. And you've been talking about this a lot. We've also mentioned that back in, the highs in 21 to the lows in 22, we saw four big market leaders, NVIDIA, Tesla, Meta, and Netflix sell off almost 70% each. So, Guy, tell me why this thing couldn't be cut in half from those recent highs.
No, I'm not going to tell you it can't happen. It absolutely could happen. And by the way, if it were in fact to happen in terms of sort of a price to sales multiple, that would put it in line with sort of historic norms. Now, nobody wants to hear that. And there are a lot of people out there that obviously have been championing this name. And, that's been great. Obviously, most of the time, there have been times, as you mentioned, now three, if I can count them, we had these engulfing patterns on three different occasions that technically have created these sell-offs. But now, not only technically, maybe you could say fundamentally, you got these sell-offs taking place. So it's not just one leg of the chair. It's now two legs in terms of technicals and potentially fundamentals. So fundamentals are just this. Again, the revenue is staggering in terms of the revenue growth, but the magnitudes of the guides and the beats now are small in comparison to where they were a few years ago. Obviously, the absolute number is bigger, but the percentage beats are getting smaller and smaller. They explained away the margin deterioration. They say you're going to see a reacceleration. The market believed them for a couple of days, and now I think the market's going to give them, you got to prove to me that 76, 77% wasn't peak margins. And I think that's where we are in this trade right now.
Yeah. So one other thing, if you broaden out the trade, right? If we want to look at Microsoft, Amazon, and Google, all three of those companies, they all sold off after their earnings. What did they do? They all bumped their CapEx as it relates to, generative AI spending, infrastructure spending, but they all saw a deceleration in their revenue growth. So I think Microsoft was down 8% the next day. I think Google was down 6% the next day after earnings, and Amazon was down 4%. All of these stocks now are down about 18% from their recent all-time highs. But Microsoft's recent all-time high was last summer. So that thing has been stuck in the mud. So you had NVIDIA that just joined the party, and look at Meta. This thing, Guy, quietly, and you and I have been talking about it on Fast Money, at some point, what did it have? 20 consecutive up days. And this is the stock that actually got me thinking about the Visa in a way, because that move looked very similar to Visa in January. So what do you think the Meta move is right now? Is it just that folks were trying to hang on to this one? This was the best sort of generative AI theme, or the last kind of man standing here a little bit, and now they're just taking profits and things.
I think that's part of it, because it's clearly not a valuation problem. But I also think, just think about how Facebook makes their money. Excuse me. It is from advertising effectively in small and medium-sized businesses. That's a big part of what's going on here. So, if that were to slow, and my point is they are not impervious to a slowdown. And I think to a certain extent, that's what we're seeing here as well.
Yeah, you want to do one. This is a name that you've been pretty bullish on for a while. This is the CrowdStrike. I think you like the move as it relates to where a lot of these cyber names sit in the world that we live in, but you also think that this is going to be one of the first beneficiaries of the use of generative AI and the investments that they make. So if everyone's looking for use cases for this technology and return on investment, you think that happens here. But this also had a melt up, just like the Visa and the Meta we were talking about.
Look at if you can do sort of longer term. I mean, CrowdStrike obviously had their issues last summer, and the stock was sold off in a violent manner. It obviously recovered that entire move and actually recently made an all-time high. The problem, of course, now I think is a valuation problem. So it would not surprise me to see the stock trade down to the 150-day moving average, which is sort of flattening out. 200-day, which comes in around $340. So I love the entire space. I think Palo Alto has sort of been my favorite in the space. The CrowdStrike, Zscaler, some of these other names are great companies as well. But I do think there's a valuation concern here, and I do think there's a chance in this environment you get down to the moving average.
Yeah, we say this all the time, valuation. You'll hear like our friends Doug Cass say this, first of all, Doug over there at thestreetpro.com, he has forgotten more about stock market valuation, risk asset valuation that I'll ever know. He was, a financial analyst. I'm not going to dox him and go how far back, but let's just say at least a few decades ago. And, he says it all the time. And I read his stuff every day. Not a good timing tool. But when the markets get like they are right now, that's when you'll hear a lot of folks, start speaking about valuation, relative valuation to its peer group, relative valuations to the market, relative valuation to its history. So I just want to do one thing right here, guys. So we have the earnings. If Amanda will let me drive here for a second, I want to go to here. Hold on one second. We're going to price up the implied move. What am I doing here for CrowdStrike? So they're going to report. Is that tonight or tomorrow? If I want to look at the at the money straddle, that's the call premium plus the put premium. Right now, the stock is trading at 377 here. So I'm going to go to the at the money, and there's a 377.5 strike in the weekly, right? So I'm going to click on the call, the offer there, and then I'm going to click on the 377.5 put offer. So that is the straddle right there. It costs you about $34. If you look at that, if you just divide by the strike, you take the combined premium of the straddle, you divide by the price, that's what you're going to get the implied move. You will need that move in either direction to make money on Friday's expiration. Now, the flip side of that is if you want to be long with defined risk, the 377.5 call is offered at about 1785. You would need a move about 18 between now and Friday's close. And the flip side of that, to the downside, you and I, we're not buyers of volatility into events like this generally, because for the most part, most stocks underperform that implied move. Why is that? The dealers that are making the prices, or the machines that are making the prices, they know generally traders want to be long premium directionally into prints, and they are going to kind of jack up that volatility, the price that you would pay for those options. So the idea of outperforming it is not a great way to make money in the options market. So again, implied move about 8.5%. I take the at the money straddle. It's a call premium plus the put premium. I divide by the strike in the weeklies, and that's what you get for an implied move, guy.
What's interesting is, a lot of these companies, a lot of these stocks that have had big implied moves, if you've been long volatility, you've been disappointed being long vol around them. And to your point, that's the market sort of pricing people's want to be long vol in those types of events, which is somewhat counterintuitive because the market's been very happy to be short vol for a long period of time. We have two quick questions or comments. The first one's about McDonald's. What's up with the strength in McDonald's? This is a name we've talked about for a while. They obviously had a bit of a misstep late last year. The stock sold off in kind, but it's gotten back on its horse. And I think it's going to trade up to the October high, which I think was 318 or so. And then we'll have a conversation. It might be a little stretched on valuation, but, this is the environment that McDonald's wins in for sure. And the other one is Apple. People say, look at the strength in Apple with the arms, it's great. Okay. I don't know what to say. All I know is when the market goes down, Apple typically outperforms unless it's an Apple specific type of thing. And I do think to a certain extent, that's what you're seeing. I mean, it's again, this flight to perceived quality in the form of the bond market. And in terms of names like Apple, I don't think it's anything more than that.
Yeah, it's moat, it's management, it's the prospect of that iPhones get kind of, some sort of exclusion or exemption from, tariffs as it relates to China. Tim Cook has done a very nice job cozying up to both President Trump and President Xi, right? And he did get an exclusion for iPhones back in the first Trump administration. But this is one that doesn't make any sense to me. I think expectations for earnings growth and sales growth are too high for this year. I think the disappointment around Apple Intelligence, that is whatever you want to call their AI sort of rollout, has been very disappointing. It did not cause the bump in iPhone sales that many analysts and investors had expected. And I think the stock has traded very poorly, if you think about it, since that initial launch, I guess, going back to the fall of Apple Intelligence. So this is one I think the fundamentals are going to catch up to it. If you're playing for this as some sort of staple play that you think is a flight to quality, as Guy just mentioned, I think you're going to find it to be very disappointing as we get closer to June when they launch supposedly the rest of this Apple Intelligence. So to me, I'm not a fan of Apple right here.
Nor am I. We wanted to throw up this before we left, this fear greed indicator. I think Doug sent this to us, or somebody sent it to us, but we're at this extreme fear now, which again, just like other things are not a timing indicator, this is not necessarily one as well, but we haven't probably been at levels like this in quite some time. But what's amazing is how quickly things can change, right? How quickly we can go from everybody feeling great to everybody feeling miserable. And a lot of that is, I think, predicated on when they see the stock market have moves like this. People get really scared on down days in the stock market, and understandably, because for a lot of people, then they've really never seen them before and they don't think it's possible to happen. Yet here we are. So I look at this and say, okay, this is probably a good level for us to bounce. And as I said earlier in the show, when you have a VIX at 25, these counter trend moves are going to be violent, both up and down. But with that said, I think there's been a bit of a paradigm shift in terms of the market. And I think it's more of a sell rally market now than a buy the dip market.
Yeah, I agree. And when you put those kind of inputs together, you just mentioned the VIX. Obviously, you see gauges like this. And then you say to yourself, there is an event tonight where we have a president who realizes he can't blame any of this on anybody else, right? Like, so the trade,
he absolutely can. But with that said, I understand what you're saying.
My point is like, he does not like to be backed into a corner, and he doesn't like to admit, when they kind of miscalculated. And again, only time will tell if that's the case. But if the stock market closes on the low today, let's go say it's down 4% in 2 days, and this is kind of in anticipation of these tariffs coming, the sort of mayhem on the geopolitical front, as we saw with Russia and Ukraine with Zelensky in the White House on Friday, that really got things going in a way, despite the stock market rallying on Friday. These last 2 days, if we were to close here, Guy, or lower, the chance of the president saying something to kind of lessen the blow on the stock market and less fearful about a recession is probably very high. So if you have a VIX north of 25, you have fear readings like this extreme, not a great press into tonight's State of the Union.
I agree. And, we'll get out of here, but, this move in Bitcoin in a 24-hour period from, I think we got down to 78,000. I think we traded up to 96,000 at some point yesterday, if I'm not mistaken, maybe just short of that. And now here we are, basically a little south of 83,000. I mean, you haven't seen volatility in Bitcoin like that in quite some time. And I think that's probably going to continue. And I'll say again, what I think is going to happen here is we trade down to that 72,000 level that we've talked about. And I think by then, the average price of the holdings on Strategy's balance sheet will be about that price. And then I think things can get really interesting, Dan.
Yeah, I mean, this goes back to what we were talking about. This is an unwind of one of the big Trump trades, right? And so if you have things like Tesla, this was the point I was making about fast money a couple of weeks ago. Remember I said, to me, two of the most important sentiment indicators right now are Bitcoin and Tesla. Tim, looked back at me and said, well, they're not, structurally that important to the economy. You know what I mean? But I just said from a sentiment standpoint. So again, I think it's going to 70 also, Guy.
I agree with that. Listen, we have our newsletter. Excuse me. Yeah. So I don't know if we can pull up a slide for that, but that's been doing really well. CC is doing a great job with that. You should definitely check it out if you haven't. I don't know why you wouldn't subscribe. It doesn't cost anything, as they said. And we've seen some really nice growth on our YouTube channel. We were looking to get to 100,000. Well, now we're north of 106,000. So things are moving fast, and that's because of everybody's help out there. So thank you. Let us know how you feel about 11 a.m. With that said, of course, I'm going to throw you a bit of a curveball. Tomorrow, we're going to be here at 1 p.m. to accommodate Elizabeth Young Thomas, and then Thursday back at 11 a.m. for Market Call, Dan.
Yeah, a lot of good stuff there. Go get that newsletter, riskreversal.com. You can sign up for it there. We have the market matrix, which is embedded in there, which we're still excited about, Guy. We have CC's great wrap of what's going on in the market, what we're looking at ahead. And obviously, he's putting a lot of our content in there with a little context also. So go check out riskreversal.com. Get the newsletter. All right, we out of here. 1 o'clock tomorrow with Liz Young Thomas. Can't wait.
Can't wait. Look forward to it. Remember, a lot could happen still today, and obviously tonight. These counter trend moves are going to be violent, so be prepared, and we'll talk to you later.